Okay, hello and welcome everyone. My name is Ákos Losz, and I'm a Senior Research Associate at the Center on Global Energy Policy at Columbia University. We are here today to discuss the new edition of the IEA's Quarterly Gas Market Report and the latest trends in the global gas market. I'm very lucky to be joined today by a very distinguished group of experts from the International Energy Agency. We have Dennis Hesselink, who is the head of the Gas, Coal and Power Markets Division at the IEA. And we also have Carol Etienne and Frederick Ritter, who are both energy analysts on the IEA's gas team. We're also lucky to have two very accomplished industry veterans joining us for the discussion. Madeline Jowdy is the Global Head of LNG Consulting at S&P Global, and Tom Marzak-Manser is the Head of Gas Analytics at ICIS. Welcome again to all of you, and thanks for joining us today. When it comes to the global gas market, I think 2024 is shaping up to be a very interesting year because we are in this strange period when the market is transitioning from a genuine energy crisis to a possible oversupply situation. And quite frankly, in 2024, we can experience both extremes within a single year. Meanwhile, we have a major disruption in LNG shipping on both the Panama Canal and the Suez Canal. And for the first time in over a decade, the US is putting the brakes on the permitting of new LNG export projects. So we will discuss all these and many other topics during this webinar. But before I turn it over to Dennis and the IEA team, let me remind everyone this is a public event, which is open to the press. We are webcasting the event live, and the full recording of the webinar will be available online in the coming days. For those of you who are joining us via Zoom, you can submit your questions for the panelists at any time by using the Q&A box on the bottom of your screen. I should also mention that our events are closed captioned, and you can turn on the captioning by clicking on the Show Caption button at the bottom of your screen. So now we will have a 20-minute presentation from the IEA, which will be followed by a 20-minute moderated discussion and a 20-minute Q&A session at the end of this program. Now, let me turn it over to Dennis, Carol, and Frederick to start us off with a presentation of the report. Dennis, Carol, Frederick, over to you.
Thanks a lot, Ákos, and thank you for the invitation to be here at the webinar. It's really nice to be able to present our quarterly gas report here at the Columbia University event. I think it's fair to say that gas markets are back at the attention of policymakers, not always for cheerful reasons. You mentioned already the unrest in the Middle East. We have the presidential statement from President Biden about LNG exports. There's lots of things happening which require attention from policymakers. Now, we cover some of it in our reports, of course, not the most recent events, but overall we look at, as you may have seen, overall supply and demand developments. The main factors driving them, is it structural, is it temporal, price formation, what's happening in the forecast, what we see happening in the near future, and then also we have special sections on low emission gases and emissions along the gas supply chain, both of which we think are really important for the gas sector overall going forward towards a low carbon future. Now, this webinar for us is a really nice opportunity, not just to present our findings and to discuss them, first of all, of course, with Madeline and with Tom, but also to get feedback from the participants. So we're very happy to, and we welcome your feedback, your suggestions to see where we could further improve our analytical work and make it available at the next occasion. Normally, we would have Gregor Molnar, our colleague, who is the lead author of the report, would present. He's unfortunately not available today, so you'll miss him today, but I have two very good replacements, Frederick Ritter and Carol Etienne, who are both gas analysts in the same team, working with us on the gas report, and they will do the presentation today. With that, I will hand over, I think, first to Frederick and then to Carol.
Great. So hopefully you can hear me and hopefully you can see my screen. Thanks very much for the introduction, Dennis. Let's jump into this report. Very quickly, a big thanks to Ákos and for the introduction as well. It is a pleasure to be able to take a bit of time and share what we've been working on for the past couple months and what we published just recently, and great to talk about it with you, with Tom and Madeline as well. So as you've mentioned, Callan and I will start off with a quick rundown of the key elements from our latest short-term reports, notably to take stock of the global gas market evolutions in 2023 and to take a look into 2024 and what we see unfolding. So let's start off here. I think looking at prices gives us a wide lens on these past few years and really does put into perspective the easing of market fundamentals that we have seen over the past year, in 2023. So this was a period where markets moved from peak structural tightness and uncertainty in 2022 toward a gradual and near continuous rebalancing in 2023. TTF, JKM prices have both fallen to levels around 70% below their 2022 averages as market tightness and fundamentals have eased, particularly in Europe. And this, what we see is that these fundamentals have proven to be much more benign in 2023 than they were in 2022. But despite this significant rebalancing, prices remain well above their pre-crisis levels in Europe and in Asia, and they remain high compared to prices in North America. So we're showing here on our chart also in green Henry Hub prices. And this means that North America on the one side and Europe and Asia on the other side continue to face substantially different gas price contexts, gas price realities, we'll say, with all the implications that this can have on demand, notably on industrial activity. So let's look a little bit into supply and demand dynamics behind this easing of fundamentals to better understand what exactly has been driving this fall in prices. So on the supply side in 2023, what we see is that it was another tough year, we'll say, for global trade in natural gas, with losses somewhat outweighing incremental volumes that came to the market. We're showing here year-on-year changes in key pipeline and LNG globally, supply globally, and we see how Russian pipeline deliveries to Europe are once again down significantly on prior year levels. So that's the dark blue segment in the chart that we're showing here. Russia did send more pipeline volumes to China through Power of Siberia. That's the upward green volumes that we see in the chart. It's been ramping up these volumes for some time now, but they continue to be or continue to pale in comparison to Europe-bound volumes that were removed from the market in 2022 and 2023, of course. Furthermore, incremental LNG supply was relatively small in 2023. We saw projects ramping up in Mozambique. We've had Calcasieu Pass in the US, Freeport in the US as well, but underperformance at a number of projects globally scaled back this LNG supply increase that had been expected in the year. So in Russia, Sakhalin-2, Yamal LNG had extensive maintenance programs. Nigeria and Egypt faced feed gas availability issues. So overall, what we see is that the supply side had relatively little to offer, we'll say, in 2023, and international trade in gas still had or still has considerable catching up to do from two difficult years in 2022 and 23. So this leaves us with demand as being the key element in easing market tensions in 2023. Let's turn to that now. Here we're looking at year-on-year changes in global demand by region and by quarter for a little bit more granularity on 2023 dynamics. What we see is two different trends unfolding in 2023, temporal trends and regional trends. The first is Europe, with an overall 7% drop in demand in 2023, skewed to Q1, given that the demand reductions in the prior year were felt mostly from Q2 onwards. So this drop in 2023 can be linked to a few factors, notably relatively mild weather, keeping heating demand low, also growing renewables and power generation and improved nuclear availability in the power sector led to a 14% drop in power sector gas demand, so quite substantial. Some of these factors were also at play in mature Asian markets, especially speaking of nuclear availability in Japan, as plants were progressively brought back online throughout the year. Now, what we see is that at a global level, however, the market saw a return to growth in the second half of the year, driven notably by China and emerging Asian gas markets. This is that other notable trend we're talking about here. More favorable price environment was at play here, allowing for improved competitiveness of gas in the power sector and also in industry as well. So overall, these two different trends netted out about 0.5% of growth in global gas demand over the year in 2023, which is good to see the markets are returning, we'll say, to growth, but it's certainly not enough to make up for the 1.5% drop that we saw in 2022. So what we see is a market rebalancing that started in 2023, really thanks to a moderate demand side picture, given the supply side additions remained relatively modest. Now, I won't spend too much time on the next slide, but it's just to give a little bit of a deep dive and to tease out tease out a few trends that we see on this demand side. We clearly see here on the chart the mild weather effect that took place in North America and in Europe. Those are the dark blue bars showing residential commercial demand going left in this chart here. We also see that industry and power are the sectors that drove demand growth across most regions. In North America, the power sector really drove growth in gas demand thanks to significant coal to gas switching. A fall in prices that we saw throughout the year really brought gas plants back deeper into the merit order again. Just as a reminder from that first slide that we were showing of prices, Henry Hub prices are about 60% down on 2022 average levels. So quite significant for power sector dynamics in the US and North America. Second region to mention here is Asia Pacific. So most of the growth came from industry, but this geographic grouping does hide somewhat opposite trends in the power sector between mature markets on one side and emerging markets on the other. So while power sector gas demand was down in markets like Japan, like Korea, thanks to greater nuclear availability, gas burn was up in markets like China, like India, and other emerging markets, thinking of Indonesia, Thailand, and Vietnam, notably. So the net effect is a near zero effect for the region, but there are important dynamics to take into account behind this high level number. So this is a snapshot of 2023, faced with a still relatively tight supply side, demand side reductions, particularly in mature gas markets, really helps ease market tensions from the volatile environment that we saw in 2022. So after 2023, what's in store for 2024 and the year ahead? We'll start off with demand here to keep it going from the previous slide. Let's start off on this chart looking at the far right of the chart, that total column. We're forecasting growth in global demand of about 100 BCM in 2024. That's 2.5% growth. About 40% of this is expected to come from residential and commercial demand, 1/3 from industry, smaller share from the power sector towards the top of that column here. But when we look at the regional split of this demand growth, this can tell us a little bit more about a key question that Dennis alluded to in the introduction: how much of this growth is fundamental or structural, and how much of it is continued recovery in a sense, and how much of it is weather effect. If we jump to the far left of the chart now, focus on ResCom, residential and commercial, much of the growth is set to be in North America and Europe. And these are two regions where, as we saw in one of the previous slides, there was a strong mild weather effect, a downside effect on demand in 2023. So a lot of this growth here is going to be linked to a sort of normal weather assumption in our modeling exercise. The remainder of the sector's growth in Asia, the Middle East, Africa is of course linked to more fundamental reasons, greater penetration of gas at the distribution scale, of course. In the industrial sector, we come across the second alternative factor that we're talking about, the recovery effect. A good chunk of this incremental demand in Europe is simply recovery from the deep cut in demand in 2022 and the minor growth that we saw in 2023. So we also see this, but to a lesser extent, in some Asia Pacific markets where lower gas prices do allow for a degree of switching back to gas in certain highly price elastic industrial sectors. And then next, I think the final section we'll focus on here on this slide is the power sector. Now, what we see is that we've got two columns to show, again, these opposite trends that we're expecting in different regions of the world. On the one hand, continued improvement in nuclear availability, renewable power growth are set to hit power sector gas burn in Europe and mature Asian markets. We're talking about JKT. This is expected to be partially offset, or this is expected, to partially offset growth in other markets, essentially to net out at around 1% growth in power sector gas demand globally. Now, we're not showing it here, but let's also have in mind the regional split here. APAC is set to account for around 40% of growth in 2024, and China accounts for around 65% of this share. So that's around a quarter of total global gas demand growth in 2024 that we're expecting to come from China. So China continues to be a primary driver of this growth in our outlook, just to keep in mind. The other side of the story is the supply side, of course. As demand picks up, we forecast incremental supply to pick up as well. Of course, we're expecting an extra 18 BCM of LNG on the market in 2024, which is up from only 12 BCM additional supply in 23. But this is still below that 2016, that dotted line that we see, 2016 to 2021 average, which was about 31 BCM of incremental supply by year over the past few years. So geographically, these volumes will be a little bit more distributed in 2024 than they were in 23. North America continues to be central with projects like Altamira, Black Means, ramp up of Freeport as well, delivering greater volumes. And we're expecting improved feed gas conditions in markets like Nigeria and Egypt. These were two markets that were hit a little bit in 2023 on these issues. New facilities ramping up like Congo LNG, Greater Tortue off the coast of West Africa. So additionally, let's just go to that next section up there. We do expect more LNG coming out of Russia following a heavy maintenance schedule that we saw in 2023 at a few plants. So overall, LNG supply is looking up, of course, but we're not quite there yet at the heart of this next big wave of incremental supply that we are expecting in the next few years, 25, 6, and 7, we'll say. Now, again, just to keep in mind, on top of what we're showing here, we should remember that we are expecting around 10 to 12 BCM of combined incremental pipeline volumes going into Europe and into China. So those are Russian pipeline volumes going into China and non-Russian volumes, of course, going into Europe. We're not showing it here, but just for to keep on the top of our mind. So all in all, incremental supply in the global gas market should be sufficient, of course, to accommodate the expected return to demand growth in 2024. But I think everyone is conscious of the risks that remain in the markets. These could be delays in commissioning projects, harsh weather effects on demand. These are rather conventional issues, of course, but other topics have been boiling up. And I think to go a little bit deeper into this, I'll hand it over to Gerhard here to touch on some of the more recent developments in this area.
Thank you, Frederick. So global gas and energy markets are facing unprecedented challenges and uncertainties in the current tight market due to limited supply, as highlighted previously by Frederick. Any disruption in the production or transportation can result in a sharp increase in prices. On the supply side, we see risk in potential delays for new liquefaction projects or underperformance in existing liquefaction plants. Feed gas issue on some legacy LNG plants, Nigeria, Egypt LNG, for instance, and the effects of Western sanctions on Russian LNG projects, such as Arctic LNG 2. On the shipping side now, Panama Canal is facing historic droughts. Restriction on ship transits is leading to increased traffic congestion and potential delays. We went from 2 to 3 days waiting time under normal conditions up to 15 days by December 2023 for unreserved slots. And the auction system set up to allow shippers to request a priority passage is increasing both cost and unpredictability. You may have heard of this record amount paid for a single ship of close to $4 million in November 2023. And what we have observed in 2023 is that the number of US LNG cargoes passing through the Panama Canal has declined sharply, particularly in Q2, with a 16% decrease year on year. And in addition, due to the rising number of attacks in the Bab el-Mandab Strait between Yemen and Djibouti, an increasing number of LNG ships change their Middle East transit routes. And shipping data indicate that in 2023, the Suez Canal accounted for 8% of the global LNG trades, with 21 BCM of LNG flowing eastward and 20 BCM flowing westward. These attacks have heightened maritime security risks and driven up regional insurance costs. And as you can see on this chart, the tensions in the region led to a complete stop of LNG shipments through the Red Sea in January 2024. This could also put upward pressure on LNG spot charter rates, ultimately resulting in higher LNG supply costs. Next, please. But so far, the effect is not visible on spot LNG freight rates, contrary to what is currently observed on oil tanker freight rates. In Q4 2023, spot LNG freight rates were at their lowest since 2020, with Atlantic freight rates down by 50% year-on-year, mainly due to muted LNG demand. It is also because LNG from the US typically lands in Europe, while Asian buyers mainly source it from closer producers such as Qatar or Australia, and they are not using the Red Sea transit. However, LNG volumes from Qatar to Europe are, of course, impacted. Qatar Energy decided to halt sending its LNG ships through the Red Sea in January 2024. As a result, Qatari LNG supplies have been reaching Europe via the Cape of Good Hope, doubling the shipping time compared with transit through the Suez Canal. But as Qatar Energy doesn't need extra shipping capacity so far, there is no impact on the spot LNG freight rates so far. That being said, the LNG shipping market could tighten as winter progresses in the Northern Hemisphere, particularly in the event of a cold spell, as LNG vessel utilization is expected to increase with ships taking longer routes to deliver to consumer markets. Next, please. So in this report, we also show the result of a survey we carried out across the members of the IEA's Task Force on Gas on GHG emissions reduction. We present the initiatives being undertaken by key gas LNG producers such as Canada, US, Australia, and Norway, and key importers such as Japan and the EU. So GHG emission from natural gas-related operations, it is to say production, processing, and transport, represented around 5% of global energy-related GHG emissions in 2022. So reducing emissions will require effort across the entire value chain. But the good news is that around 40% of methane emissions from oil and gas operations could be avoided at zero net cost via measures such as leak detection, repair programs, and installing emissions control devices. In the case of LNG, the use of electric drives instead of gas turbines to power the liquefaction compressors significantly improves the environmental performance of an LNG plant, provided that the electricity is produced from renewables. In addition, CCUS-based solution can be applied directly at the liquefaction plant level. For its part, the emissions intensity of LNG shipping can be improved by via better fuel efficiency standards, enhanced boil-off gas management systems, and speed reduction. In a nutshell, this survey highlights the urgent need for a consistent, universally accepted framework for reporting GHG emission, to define the scope and the methodology to be used. Many initiatives already exist, such as GMP 2.0, the US DOE MMRV framework for natural gas, or the GII-GNL neutral LNG cargo framework. But these initiatives have different scopes, with some focusing primarily on methanes, while others focus on specific parts of the supply chain. So one of the main outcomes of COP28 last year was the launch of the Global Methane Pledge, a voluntary initiative by over 150 countries representing a little over 50% of global methane emissions, to reduce them by 30% below 2022 levels by 2030. The Global Methane Pledge also aims to establish this common framework to report GHG emissions along the gas value chains from production to the end use of natural gas. Next, please. So let's now move on to low-emission gases, which includes biomethane, low-emission hydrogen, and e-methane. As alternatives to fossil fuels, low-emission gases can play a crucial role in decarbonizing gas supply chains and the energy system as a whole. 2023 saw the introduction of a significant number of new policies in Europe. As a reminder, the REPowerEU plan decided in 2022 targets domestic renewable H2 production of 10 million tonnes per year and imports of another 10 million tonnes per year by 2030. In 2023, we saw the launch of the European Hydrogen Bank, which is investing in hydrogen projects. And there were also the new regulatory framework, which sets guidelines for the gradual implementation of non-discriminatory third-party access for future hydrogen networks. As a reminder, nearly 30,000 kilometers of hydrogen pipelines could be built in Europe by the early 2030s. This includes as well national initiatives such as in Germany, Ireland, and France. Meanwhile, in the US, the National Clean Hydrogen Strategy and Roadmap, published in June 2023, outlines targets and actions to increase low-emission hydrogen production and to reduce costs to support the deployment of the production. And there was it's worth mentioning the creation of 7 H2 hubs spread across the whole country, which are expected to produce in total 3 million tonnes per year of low-emission indirect hydrogen by 2030. In Japan, the basic hydrogen strategy outlines the targets and partnerships needed to increase domestic and global hydrogen demand, with the objective to lower hydrogen costs as well, and to improve energy security with e-methane. Last but not least, in India, the National Green Hydrogen Mission, approved in January 2023, aims to boost low-emission hydrogen production with a target of 5 million tonnes per year produced by 2030, with financial incentives for electrolyzers and blending mandates for natural gas. Next, please. Among low-emission gases, biomethane has been gaining increasing attention and continued to expand strongly in 2023. Last year, global biomethane production increased by 12% globally to reach almost 8 BCM. This strong growth was driven by the United States and the European Union, as you can see on the chart, together accounting for 80% of incremental biomethane supply. The United States remain as the world's largest producer of renewable natural gas, and even increased its production by 10% to reach almost 2.2 BCM in 2023. In the US, this growth is driven by the transport sector, which is supported by favorable policies and incentives, such as the tax credits and the renewable fuel standard implemented by the EPA. In Europe, now biomethane production grew by just over 10%, supported by Denmark, whereas the share of biomethane in the grid reached a record of 38%. And France as well reached 0.9 BCM injected in the grid last year. Next slide. So our last slide gives the key takeaways for 2023 and 2024. I won't go deeply into details to leave room for discussion. Just to sum up, the global gas market will remain tight in 2024 with geopolitical risks on the rise. So we haven't covered every topic, far from it. So we would be happy to answer any questions you may have.
Thank you very much, Carol, Frederick, and Dennis. Thanks. It was a very comprehensive overview, a great presentation as always. It certainly gave us a lot of material to discuss in the moderated part of this webinar. Again, for those of you who are watching online, my name is Ákos Lósz, and I'm here with Dennis Hesseling, Carol Etienne, and Frederick Ritter from the IEA, Madeleine Jaudy from S&P Global, and Tom Marzek-Manser from ICIS, and we're discussing the IEA's quarterly gas market report. We will open up the Q&A after this panel discussion. For those of you who are joining us via Zoom, you can submit your questions at any time using the Q&A function at the bottom of your screen. But before we get to my questions to you, let me ask Madeleine and Tom if they would like to comment on anything in particular that the IEA raised in their presentation or in their report. So let me come to you, Madeleine, first. What are your takeaways?
Thank you, Ákos, and thank you to the Center for Global Energy Policy for bringing us together, and the IEA for your excellent report and commentary. So I think the report raises three critical issues pertaining to gas market growth that are loosely interconnected. And the first, which Frederick touched on, is the questions around the structural nature of gas demand, particularly in Asia. And so I think as we see prices and weather normalize in the coming year, we're going to get a really unvarnished view of the nature of demand. And given the structural demand losses in JKT, so Japan, Korea, Taiwan, really offset about roughly half of the demand growth that we saw in the region. And so we're going to really need to take a closer look at the structural demand drivers of the biggest growth markets in Asia, so particularly power generation in China and industrial demand in India and power generation in Southeast Asia. And the reason we need to really carefully scrutinize this when we're sort of thinking about the nature of gas demand is that, by longer term, by 2040, we're seeing gas demand plateauing to varying degrees in the region, and that's not that far away. We're in 2024. Second issue, or second thing raised in the report, not so much touched on in this presentation, but it's really important to understanding demand growth expectations, is issues around security of supply. And this has long been a concern, globally in gas markets, but I think there's been more scrutiny on the LNG portion of the supply chain in the post-Ukraine invasion world. And we've seen key Asian buyers in Japan, Singapore, China mandate storage and procurement programs. And in India, we've seen the establishment of a unified pipeline tariff to ease access to supply inland. And, this can have sort of a somewhat perverse effect of impinging, if you will, on market liquidity and market deregulation efforts. Another story. Finally, in order to maintain and grow the role of gas in the supply mix, there's a very clear effort to reduce the GHG emissions profile of gas and LNG globally, what I call quality of supply focus. And as Carol mentioned or went through, the IEA in this report did a really, really thorough survey of global suppliers to see what they're doing to reduce GHG emissions. So this isn't just, pledges and talk. There's actually been verifiable action on the part of suppliers, particularly along the value chain in gas. And we've seen a lot of movement, particularly in the US and Australia on the liquefaction front. So those are my initial comments. Thank you.
Thank you very much, Madeline. Great points. And thanks especially for bringing up the importance of Asia and greenhouse gas emissions along the gas supply chain. We want to cover both of those topics later on in the discussion. But let me now turn to Tom first. Tom, what do you think about the IEA's outlook? Over to you.
Thanks, Akash, and echoing Madeline, thank you to both the IEA and yourselves for hosting this event for the community. The things that I wanted to kind of comment on briefly, maybe as Carol mentioned at the very end, the report is so much more than what we've seen this morning or this afternoon, depending on where we are. And before we dive into the greater conversation about the security supply situation, the latest pause from Biden and the like, I just kind of implore everyone to actually make sure they have a full read of the report. There's some great nuggets in there that help us in the community to understand where growth is. And I think Madeline's already mentioned the policy changes in India, for example, unifying the tariff system there. There's some very good detail within the report about how that's playing out. And you think about India and the growth potential that market has, policy expectations that gas will go in the energy mix from something like 6% to 15% in the coming 5-6 years. So really, that's quite a big impact in terms of an LNG demand source, if you think about how much of that will come from the LNG market. So yeah, great nuggets in there. That's just one example. And then the other thing that I really thought was a key message and a key highlights confidence that the market has is the chapter in the report which talks about the churn and traded volumes. We've seen the price come down at the TTF over the last year, but as we know, it's a lower price. It's not a low price. And yet we've seen the churn ratio, the measure of how many times effectively a molecule is traded between counterparties before it's consumed, rise significantly year on year, and in fact go to all-time highs. The IEA statistics show that that's a churn ratio of 17, far and away above what's happening in Asia. So identifying TTF as a global balancing point, as it were, it shows that it's kind of rooted in the market. It's got confidence in the market participants who trade that market, that there is a lot of volume there. And I think that's a really good indicator that while the prices are still volatile and the prices are still high, there is confidence in that market.
Thanks very much, Tom. And Carol, Frederick, I think if I paraphrase your main conclusion right, I think we are seeing a market loosening, but we are far from out of the crisis yet. And you mentioned several factors that could still bring us back to crisis mode. And I see in the questions someone's asking about the future of the gas transit agreement between Russia and Ukraine. You didn't mention that. Do you see the expiration of that agreement as a potential risk factor which could significantly tighten up the market, or you're not too much concerned about this?
So yeah, maybe I'll just jump in here. It's a good question. That figures in our outlooks, and we don't expect that to be put in place again, or once that's out of the books, it's out of the books. However, we don't expect this to be a key factor in tightening up the market much more than we see the market today. I think by that time, demand will be not in a hugely different position as it is today, and I think Europe will have the right supply options to make up for these volumes.
And then maybe the other side of that balance is that if you look at the storage levels, they are at a quite comfortable level, just below last year's level at the same time of the year, and at the same time we have a little more LNG coming to the market. We still have maybe a little gas in Ukrainian storage, which wasn't the case last year. So can you conceivably see a scenario where we have an early onset of this glut starting already this year? Is that a possibility in your outlook?
Yeah, I guess I'd start off by saying that we're I don't want to say that the market is on a knife edge in 2024, but if it were on a knife edge, the edge is not the sharpest in the world, but it's still somewhat of a fine line. So things could turn out fine and well, and as we've discussed, there are a few risk points that could tighten up the market. When we look at 2022, a huge factor in these loosening up conditions, fundamental conditions loosening up, was market confidence that Europe was fine at a certain point through winter, because storage was very, very high. As you've just mentioned, EU storage levels are about just 1 BCM below where they were at the same point last year. So broadly, same situation. What we see is that the market is very confident in the EU's ability and Europe's ability to get through the winter. And this does mean that end of winter levels are likely to be high. This will reduce the call on LNG. Don't have a crystal ball. I can't say if there will be a glut, but it's certainly not crazy to think that this will be a clear loosening factor in the market.
You monitor the European market quite closely as well. Do you have a different view on any of this?
Yeah, I guess you started off by asking about, will Russian transit through Ukraine continue into 2025? I think that was the question. I mean, I'm of the view that it will actually. While the transit agreement will expire, it's a 5-year transit agreement. It is obviously between Gazprom and Naftogaz of Ukraine. I can't see a agreement being signed between those parties, but I think there are still market players within the Central European market that will find a way, using various market mechanisms that are available to them, to get that gas, or at least some of that gas, to them. Let's not blow out proportion. What is flowing through Ukraine from Russia to Europe is about half of what Gazprom is selling into Europe, and that means it's about 1-2% of European supply. So even if it loses, I share Frederick's point. If it does go, it's not going to be a huge game changer. On the second point about the glut, when I think of gluts, I think back to the spring and summer of 2020 and what that meant for LNG producers in the US, and I certainly can't see that happening this year. Yes, we could see some prices falling in the summer of 2024 at TTF, but we know we've just broken through it, right? The sort of $10 per MMBTU mark, which really starts to draw South Asian players out into the buy side of cargoes, and I think we'll see some Bangladeshi buyers, Pakistani buyers really come to the market to absorb some of that volume. So there will be more volume available to non-European markets. Does that mean a glut? I'm not sure.
Okay, very good. And Carol, appreciate the detail you already gave us about the Panama and the Suez Canal disruptions. But you also highlighted the fact that the market has seemingly brushing these concerns off, and it's not really visible either in the prices or in the shipping rates so far. So my question is, can the market actually sustainably operate without these two crucial shipping routes, or is it just a matter of time until we run into some serious supply disruptions related to these canal limitations? And also you mentioned the possibility of cold spells pushing us to that point, but assuming we avoid any cold spells this winter, what else can make this become a disruptive event?
Thank you, Akosh. So yeah, I don't have any crystal ball either, but what we have observed so far is that there is no impact on LNG spot price, freight rates, but it can still happen. Considering that there is a spare capacity on the LNG shipping, I think it won't happen overnight. But another risk we didn't mention during this presentation is the potential stop in transit in Hormuz Strait, which would have a huge impact on the LNG markets, because, as you know, Qatar is representing 20% of the LNG global supply. So in a case of such a disruption, this would have a great impact. And this has to be kept in mind.
Very good. Tom, Madeline, do you want to comment anything in addition to the Panama Canal and the Suez Canal issues, or shall we move?
No, just I think, and someone made a question about this, but I think we're going to just see what we have seen is just a regionalization of the trade. And actually, ironically, that contributes to shipping efficiency, of which this market is definitely guilty of inefficiencies in global LNG trade.
Great. Of course, the big question on everyone's minds, at least on this part of the Atlantic, or this side of the Atlantic, is this recent decision by the US government to temporarily hold the permitting of new LNG export capacities. So, as the US-based member of our panel, Madeline, let me ask you first, what's your take on this decision? What are the market implications in particular?
Oh boy. Yeah, so I think, as most people have pointed out, for all practical purposes, this isn't going to affect the basically doubling of US LNG supply over the next 5 years. So the supply that has been FID'd and, is under construction or about to start construction, there is not going to be any impact on that supply. So, nothing to worry about right away. But what this does have the immediate effect of this is to really just delay anything that is, so anything in our outlook that we had for FID this year, which is about, I think, around 14 million tons of additional LNG, that's all going to be delayed by a year. And so, the impact is going to be on both the financing side, and then also impact is going to be on the buyers who've already signed SPAs for these pre-FID projects. So that's going to cause concern on some of the Japanese and European buyers that have already subscribed to this supply. But again, I think, and certainly this can all be reversed with the next election, but clearly there's going to be a delay.
Okay, and assuming that this pause continues or even gets extended, I mean, the big question, of course, is whether any more US LNG or any other LNG is needed in the sort of 2030 to 2050 timeframe, and if it's not coming from the US, then can the other suppliers easily fill that supply gap, assuming there is one? So, what's your sort of longer term view of the LNG market balance?
Yeah, I think, longer term, I think, well, first of all, just in terms of the other suppliers, I mean, outside of Qatar, which is also, geared up for incredible supply growth, the issue isn't, to my mind, the issue isn't like, well, all of a sudden, do these other suppliers just look a lot better? Because the problems with other suppliers, I mean, particularly in East Africa and other emerging suppliers, it's not about because the US looks better, it's about sort of specific problems to those suppliers in particular. So basically political risk problems or, pipeline expansion problems, getting gas out of Canada West Coast. So, that question is, does the world need LNG after 2030? And that's a tricky one, right? It's all kind of a function of price and flexibility. And what we see with the US supply in particular is that there's a tremendous amount of flexibility in that supply in terms of destination and in terms of Henry Hub exposure as opposed to oil index exposure. And so that's what makes US gas and LNG so incredibly attractive.
Let's see if Tom wants to comment as well.
Firstly, I think I just back to you, Akash, for being very humble in not flagging up the lovely digestible paper that you, Ira, and Sophie put out, I think, yesterday on exactly this point. So if you haven't read it, guys, on the call, please do go see it. It's really easy to read. The point I wanted to come back to was the price impact of what this is happening, and as has already been mentioned, this is not impacting plants that are operational or plants that are being built and have FID'd, and therefore there's no immediate impact to the S&D balance for the sort of 5-6 years ahead. I noticed though, actually, when I looked at TTF forward curve pricing, and up until this, you could take the TTF forward curve and divide it into two effectively. The bit that is between the present day, whenever that was, if it's today or if it was 2 years ago, and the day that effectively the time you expected Qatar and this upcoming US wave coming online, and the bit after that. And effectively what we've seen is the price come down of the TTF in that first half, and the second half has remained flat, unchanged, unmoved by the volatility on the front end. What's happened, and I noticed this, is that the TTF in 2028 is now higher than it was 3 weeks ago. And I think that's very, very interesting. So that point Madeline made about European buyers, Asian buyers who may be contracted or had signed SPAs, are they getting a little bit worried? Have they bought back a little bit on the expectation that maybe there will be a delay or two in those projects coming online? I don't know, but it's a really interesting dynamic to see that section of the forward curve move up, while in the last 2 weeks, the rest of the forward curve, the front couple of months and years have come down. I think that's quite an interesting point.
Very interesting. Thanks for pointing that out. And of course, the IEA report has an extensive session about the greenhouse gas footprint of LNG, and at the core of this decision is concern about the greenhouse gas emissions profile of US LNG supply. So I wonder if the IEA team can comment on best practices worldwide. If the US government is actually serious about limiting the greenhouse gas emissions associated with US liquefaction projects, then what would be some good case studies to study, both in terms of operational issues, what can plants do to actually limit the greenhouse gas emissions along mostly along the liquefaction and the LNG transport parts of the supply chain, and also what other regulatory experiences there. I'm thinking about your case study about Australia, for example, which might be interesting to this discussion. So, Carol, perhaps I turn to you. Can you comment on this further?
Yeah, as I highlighted during my presentation, there is a need to assess more precisely and to have a common framework to be able to compare the different liquefaction plant emission intensity among them. So yeah, it would be interesting to have this assessment to make sure that the carbon intensity is decreasing with years, and it is important for the US to make sure that all the new projects that come in line are in line with the different trends to decrease the GHG emissions. Yeah.
Okay, very good. And I see a question here about European industrial gas demand, and I think it's been one of the enduring mysteries of the last few years that we've seen price declines all around the place, but not a recovery in European industrial activity and industrial gas consumption in particular. So I wonder if that's going to be the case, or that there's just a delayed recovery and the recovery is still coming. So maybe first turn to Tom, and also curious to hear the IEA's view about the prospects of industrial gas demand in Europe in particular. How much is permanently lost? How much is still coming back?
I think the first thing to say is that probably industrial gas demand in Europe has probably peaked. So whether some comes back, yes, probably in due course, but in terms of it, will it ever rise again to the levels it was before? No. But the thing that I think it's important when thinking about industrial gas demand in Europe is that it's not just about the cost of energy. In some industrials are facing the cost of energy problem, but also the fact that there is overcapacity in the production of many petrochemicals, which are very, very energy intensive. The assumptions that were made on FID projects in, say, 2017 about the rate of petrochemical consumption around the world was obviously led to a wave of projects being built in lower cost markets in US Gulf, in Middle East, in China, and then we had COVID, and then we've had the war, and that means that the industrial units in Europe are old, rickety, expensive to run, and therefore, if you've got overcapacity, unfortunately, they're probably the ones that are going to not play a part in the future. So I think that's my message really here is that don't just think, oh, it's cheaper prices from an energy perspective, why they're not running. There's a deeper story there we need to think about.
Yeah, Frederick, Carol, would you like to weigh in on the European industrial gas demand question?
Yeah, just quick message on what Tom said. Yeah, I completely agree. I think when we were looking back at 2022, we saw around 30 BCM or so of EU or European industrial gas demand disappear. Our calculations were that about half of this was certainly never to come back. Now, will that other half really come back, or is it more there's a potential for it to come back? Energy prices are a big thing, of course. Thinking about the industries of tomorrow as well. Are we moving to more electrification? How much progress will we make on efficiency in industrial processes? These are also questions that are going to play in on how much of this second half of the lost demand could actually come back. But yeah, definitely agree with what Tom just mentioned.
Great. I see a question here from Andreas Schröder, former IEA colleague, asking about the IEA's projections for biomethane. Are you expecting this kind of almost exponential trajectory to continue, and if so, how long into the future?
We forecast an increase, of course, of biomethane production worldwide. I don't have the figures in mind right now, but I can check and revert.
It's a question about Russian gas ever returning in greater volumes to the European market. Tom, maybe you want to take on that?
I just had this question the other day, actually, from one of our customers. This is a problem that some long-term contract holders of Gazprom's customers in Europe have. Is that do they assume their post-Ukraine war that part of the deal, the reparations or whatever you want to call it, does that allows gas to flow again? The Yamal-Europe pipeline, the one that goes through Belarus and Poland, is basically good to go. It doesn't need, it doesn't have the situation of the Nord Streams. It doesn't have to go through a third country in the form of Ukraine. It's certainly an ongoing risk that if you're a buyer in Germany, a buyer in Italy, a buyer in Austria, and you've got those contracts, that you may end up having to off-take volume if you don't want to go to arbitration if the Ukraine war ends. So it's certainly it's plausible. I don't know if it's possible.
Great. And before we wrap up, I want to touch upon Madeline's question about Asian gas demand broadly. I think China was expected to recover strongly last year. It didn't quite, and maybe the recovery is still to come this year, and also emerging Asia. I'm just curious, Madeline, do you see a strong recovery of LNG demand in China this year, and also do you see any price responsive demand coming from Southeast Asia in particular?
Yeah, well, I'll take the easy one first, and that is, certainly as prices normalize, we're pretty definitely going to see, a demand response in places like Bangladesh and Pakistan, and India. China's a little bit trickier. I think there's a risk of a really, really strong gas demand recovery in China, only because of the sort of economic currents that are or cross currents or counter winds that are happening in China now. The other thing in China that's interesting, and this is sort of pertaining to security of supply, one of the things that we've been looking at really closely is whether or not there's going to be a deal for Power of Siberia 2, which would bring another 50 BCM of gas into the Chinese market. And that would have a sort of clear sort of counter effect on LNG imports into northern China. But I would say I'm hedging my bets on a really strong Chinese gas demand recovery this year.
Okay, great. Thank you, Madeline. Fortunately, this brings us to the end of this webinar. But before we wrap up, let me take a brief moment to thank our speakers for joining us today, especially the IEA, for coming again to present their outlook. We very much hope that we can welcome you back again soon. And many thanks also to Madeline and Tom for sharing their insights and expertise with us today. Also very big thanks to our audience for tuning in and for the great questions in the Q&A. As we mentioned earlier, the full recording of this event will be available on the Center on Global Energy Policy's website later today. Our next public event is about carriers in climate finance, and it will be held on the 7th of February at 5:30 p.m. Eastern Time at NYU. For a full list of our upcoming events, please visit the Center on Global Energy Policy website. We hope to see you again soon. Thank you and goodbye.